If you pay for income protection insurance, there is a very good chance you are leaving money on the table every single year. In e-tax analysis, only 2% of Australian taxpayers claimed a deduction for income protection premiums, even though the ATO explicitly allows it. Today, I am going to walk you through exactly how to check your cover, how to claim the deduction, and how to make sure your protection is actually structured the right way. Let us get into it. Here is the headline number. According to e-tax, just 2% of Australian taxpayers claimed a tax deduction for their income protection premiums. The ATO says you can claim the cost of any premiums you paid for insurance against the loss of your income. So why are 98% of people not claiming it? Usually because they do not know it exists, or because their cover is structured in a way that quietly kills the deduction. Both are fixable. Before the steps, let me show you why this matters. Say you pay around $100-$200 a year for a standalone income protection policy. That is a realistic mid-range premium. My assumption, not a regulator figure. If your marginal tax rate is 34.5%, including the Medicare levy, which applies in the $45,001 to $135,000 bracket per the ATO, claiming the deduction is worth about $414 in tax every year. Over 20 years of never claiming, that is roughly $8,280 in avoidable tax. And that is just the deduction. If your cover is inside super, you may also be missing it entirely, while your future benefits get taxed like salary. So this is worth 10 minutes of your time. Move 1. Find out where your cover lives. This is the single biggest factor. Log into your Superfund online account, usually through MyGov, linked to your fund, and open your latest statement. Look under the insurance section for anything labelled income protection or salary continuance. Write down the policy type and the annual premium being deducted. Then check your own bank account for any insurance premiums coming out directly. The key question is simple. Are the premiums coming out of your super contributions or out of your own pocket? Because that one detail decides whether you can claim a deduction at all. Here is the rule you need to burn into your memory. The ATO states clearly, you cannot claim a deduction if the policy is through your superannuation fund and the premiums are deducted from your contributions. E-tax says the same thing. You can get a tax deduction for income protection as long as it is not arranged as part of your superannuation. So if your only cover is the default policy inside your super fund, your personal deduction is zero. That is not necessarily wrong, but you should be choosing it deliberately, not by accident. Move 2. Work out exactly what you can claim. Grab your latest income protection policy schedule or annual statement. If your cover is bundled with life or TPD, this matters a lot. Suncorp explains that if only $250 of a $1,000 bundled premium relates to income protection, only the $250 portion is tax deductible. So you cannot just claim the whole bundle. Find the income protection only portion, then add up everything you paid across the financial year. That is your monthly premium times 12, or whatever your statement shows. That total is the number you will claim. Now to actually claim it. In MyTax, go to the deduction section and open other deductions. The ATO MyTax instructions explicitly say you can claim the cost of any premiums you paid for insurance against the loss of your income. Enter your total income protection only premiums there, labelled clearly as income protection insurance premiums. That is it. For someone at a 34.5% marginal rate paying $1,200, this single entry brings the effective out-of-pocket cost down to about $786, with the rest funded through reduced tax based on ATO rates. Good looks like this entry appearing every single year. Poor looks like paying premiums from your bank account with nothing under other deductions. Move 3. Decide whether to restructure. Read the MoneySmart income protection page first to understand benefit levels, which MoneySmart says typically run between 75 and 90% of pre-tax income. Then ask your super fund for your current policy, wording and premium, and get a quote for comparable standalone cover from a licensed insurer. Same waiting period, same benefit period. Compare 3 things: the premium inside super with no deduction, the standalone premium outside super, which is generally deductible per the ATO, and the actual benefit definitions. If the standalone policy gives you better after-tax protection, apply for it first, and only cancel your super cover once the new policy is locked in and active. Here is something almost everyone gets wrong. People assume income protection benefits are tax-free. They are not. The ATO says if you receive a payment to replace salary and wages, you must include it in your tax return. E-tax and Money Smart note these policies typically pay around 75% of your pre-tax income. So if you earn $90,000, a typical benefit is around $6,000, $7,500 a year, but at a 34.5% marginal rate, you could pay roughly $23,287 in tax on it, netting about $44,213, modelled using the published ATO rate. Your 75% replacement is really much closer to half your gross salary after tax. The most common mistake after not claiming at all is overclaiming on a bundled policy. Take Sarah, a 37-year-old marketing manager. She gets a bundled retail quote at $500 a year, with only $500 attributed to income protection and $1,000 to life and TPD, a typical structure described by Suncorp. At a 39% marginal rate, she can only deduct about $195. That is 39% of the $500 income protection portion, not 39% of the full $1,500. If she had claimed the whole bundle, she would be filing an incorrect return. Always check the breakdown so you claim exactly the right amount and not $1 more. Let me put it all together with Sarah. If she keeps her cover inside super at $800 a year for 28 years, she misses a deduction worth about $312 annually at her 39% rate. That is roughly $8,736 in extra tax over her career. Then if she has a 3-year disability claim on a 75% benefit of $82,500, she pays around $32,175 in tax each of those years based on ATO rates. Combined, the modelled hit is around $105,000 compared to a properly structured standalone policy outside super. To be clear, that $105,000 figure is a modelled scenario using ATO rates and e-tax and Money Smart benefit structures, not a regulator projection, but the direction is real. One more thing to flag. Industry advisory content referencing ATO practice cited a $3,000 per year limit on deductible income protection premiums as of the 2022 financial year. Now, that is not a formally codified ATO threshold, and it may be revised, so do not treat it as gospel. But if your premiums are very high, it is worth confirming. And remember, marginal tax brackets and the Medicare levy can change with future federal budgets, so always recheck the current ATO income protection and My Tax Other deductions pages for the financial year you are lodging. Let us recap fast. Move 1. Log into your super and find out whether your income protection is inside super or paid personally. Move 2. Isolate the income protection only portion of your premium, then enter it in My Tax under Other Deductions. Move 3. Compare your super cover against a standalone quote with matching terms and restructure if the after-tax maths wins. And never forget, only personally paid premiums are deductible, and any benefit you receive is taxable income. Get those right and you stop leaving money on the table. If this saved you even a few $100s, do me a favour and hit subscribe. We break down one quiet Australian money trap every week in plain English. Next up, I am covering how to structure your super contributions to cut your tax before June 30th. Remember, this is general information only and not financial advice, so check your own situation against the latest ATO pages or chat to a licensed advisor. I will see you in the next one.